Hi all, welcome to Diversified Finance. My name is Lakal and today I'm gonna go through this article um, regards to banking regulators and out of cycle rate hikes. Regulators not awake as banks behaved appallingly. Costello. Mr. Costello said the Bank Royal Commission would probably mean tougher regulation and lower profitability for the bank sector, but he saved his biggest serve for the likes of Australian Security and Investment Commission, which reported to him in his days as a treasurer. Mr. Costello said evidence presented at the Banking Royal Commission made it clear that some of the big banks behaved appallingly. Yeah, which is obvious to us already. So banks being lending money carelessly, like without going through a thorough check whether their borrowers would be able to pay it back. So in simple words, they've been over lending to their borrowers, and right now, they are struggling, and we can see mortgage stress is really high at the moment. And then we heard there's probably over 1 million households in mortgage, like severe mortgage stress. So for the reason for that is they probably borrowed too much money, and now they are struggling to service their repayments, service their mortgage. So for example, you have your responsibilities as a borrower, and looking from banking perspective, as a banker, you have your responsibility to make sure your borrower can meet certain requirements, and then the borrower would be able to repay your loan without any struggle. So meaning, for example, if you have to pay 40 to 50% of your salary as a mortgage repayment, of course, so then you have another 40 to 50% of your salary for other expenses. So it's obvious, mortgage repayment is not the only expense for an average human being. So we have other expenses, like, who knows, if you have a car, you probably have a car loan, so you have to repay your car loan. And you have other expenses like electricity, gas, council rates, and if you have a mobile phone, you got a mobile phone bill. So there are various other expenses that you go through as a normal human being. So if 50% or 40 to 50% of your salary goes to your mortgage, there will be a time, you can do it for some time, you can struggle, you can cut down from here and there just to keep up with your mortgage repayments, but there's a limit that you can do so. So ASIC and APRA, they are the bank regulators, so they are there for a reason. So there's a tendency, as a lender, you can keep on lending money because that's their job. As a lender, if I'm a bank, the only way the bank gonna make more money by lending more money. So they will always try to lend more money, and they might overlend, then they could be greedy at times, and they might start lending a little bit more than they're supposed to. So that's why we have regulators, like for ASIC, for example, ASIC and APRA, to protect the consumer. So their job is to make sure banks not going to overlend. But according to looking at the history, for the past 4 to 5 years, we heard there's 500 billion lie loans, meaning people put fake incomes, and then they put fake lower expenses in order to get your loan approved. So as a bank, you probably wouldn't care, because more you lend, more money you make. But that's why we have regulators, to make sure they go through their books and make sure that banks are doing their job properly, just to protect the consumer. But looking at the past, it looks like it hasn't been done, so they have not been done their job properly. So this is what Costello explains. So he further says it's clear that the people were responsible for administering the banks probably haven't done their jobs. I think that the next step for Royal Commission to actually find out why the regulatory agencies weren't awake at the wheel. Speaking at the release of the full year results of the Future Fund, which he chairs, Mr. Costello said the upshot of Royal Commission will be tighter credit, more expensive financial advice, and less profitable banks. So yeah, so now according to the Royal Commission, we already know what banks have been doing. So we know that they've been overlending, they've been lending more money for customers without checking their ability to pay it back for the next 4 to 5 years, 30 years or so. So we know that they've been doing this, that they're not supposed to do it. But then we have the question, so what about the APRA? What about APRA and ASIC? Their job is to go through banks books and make sure that this won't happen. So it looks as if for the last 5 years, or maybe even last 10 years or so, they have not been doing their job properly. And it would be nice, if we can have another Royal Commission into ASIC and APRA to find out why they haven't been doing their job properly, why they haven't been looking into banks books to make sure that something like this happen. And then he further says credit will probably get harder because of the obligation of the banks to access the creditworthiness of customers will probably increase. So that will have an effect on more general economy, Mr. Costello said. So yeah, because of this could affect the economy, because because due to tight lending, then there'll be less money people can borrow less money even for businesses. Then they won't be able to borrow enough money because they have to go through a tighter lending. So if you look at the last 5 years, lending was easy, so funds were easily available. Even if you want to run a business, you'd probably be able to get a loan easily. So probably because of that, maybe we have seen a boom, artificial boom for a short period of time. But right now what happens, due to tighter lending, even if you want to start a business, it'll be really hard for you to borrow money. So if that happens, this could directly affect the economy, because there won't be new businesses, people won't be starting new businesses, and because of that there won't be any new created jobs. And moreover, people who borrowed money, they have to keep on cutting down on the expenses, meaning they won't be able to spend the way they used to spend a few years ago. So for example, even when the housing market is the median house price used to when it was around $1 million or more, people have that tendency, you feel good about it, so you tend to go out there and spend more money, because you tend to think, at least on the paper, the value of my house is 1 million. But now we are seeing the housing market is coming down, it's cooling down a bit, so we've seen it's 10 to 15% down to date. So then people have this urgency, looks like housing market is going down, I'm not going to spend more money and I have to cut down on my expenses. Moreover, when you see rising interest rates, banks RBA did not raise interest rate, but out of cycle big four banks and smaller banks, they increased the interest rate. So this is concerning for the consumer. So more we see this, less they spend, and it's less they spend, we'll see more businesses go bankrupt, and then it will definitely directly affect the economy. And he further says, regards to out of cycle hikes, Mr. Costello also suggested that banks will now have to make out of cycle interest rates increases, but this was due to global issues and not the Royal Commission. So yeah, so as we know, global rates are rising because Federal Reserve, US Federal Reserve, they already mentioned, and they already increased interest rates in September, and then they further mentioned that they're gonna increase interest rates in December, and in probably another 3 to 4 interest rates hikes in 2019. So regardless of whether we like it or not, global interest rates are going up. So if interest rates keeps on going up, then compared to US dollar, Australian dollar will fall. Like we've seen times, Australian dollar used to be as same as US dollar, but right now it's around 70 cents. So when in US, when they keep on increasing interest rates, compared to US dollar, Australian dollar will probably going to decline. So regardless whether the RBA like it or not, they will force to increase interest rate. But even if they not going to say, for example, RBA is happy to see when Australian dollar falls to 60 cents of for one US dollar, banks will definitely have to increase their rates out of cycle. So regardless of what RBA does, banks will definitely increase interest rates. So if that happens, things gonna get uglier, because we already people are feeling the pressure. Like there's a lot of more than a million households are in mortgage stress. So if they see increasing interest rates, right? If the bank's gonna keep on increasing interest rates, your repayments gonna get bigger. So for example, it could go up by another $100, $200 or $300 a month or so. And if that happens, there's most likely more people wouldn't be able to service their mortgage, especially investors. They might think, okay, maybe it's time for me to sell. If that happens, we'll probably see more people trying to sell, trying to get out of the housing market at the same time. Like we might see like a fire sale also, where the supply increases massively in an environment where there's like less demand. And because of that, we might see that's why most people, experts are predicting the 40 to 50% a drop in housing market because of these conditions. Because right now the global crash rate, even global crash rate and even Australian crash rate is around 1.5%. Global crash rate, so for example in US crash rate is around 2.25%. So even if you look at it, these cash rates are really, really low. So we remember at times we've seen 8-9% cash rate, probably in just after the GFC in 2008. So even if it goes up to 5%, there'll be a lot of households gonna struggle because the repayments gonna increase. So the best bet is for us, if someone questions, okay, what we supposed to do, the best bet is it's a really good time for us to reduce our debt if it's possible. Say for example, if someone has 3 to 4 investment properties, maybe it's time to sit down and think, okay, am I gonna sell maybe 2 properties out of my property portfolio just to reduce my debt levels? Because if interest rate keeps on going up, there'll be a day that you might not be able to service your mortgage. Plus, when there's more supply, rental market could crash and rental price could go down massively. So repayments tend to increase in an environment where your rental market's going to go down, meaning your rental income might not cover. If it's negative gearing, of course you don't want it to cover, because you can claim more from you can do more tax deductions. But what if your repayment is say $500 a week and your rent drops to 250 or maybe 200, for example, I'm saying. So if that happens, then you have to pay $300 out of your pocket. So then then that could be like an extra expense. You might not be able to retain that that innocent property. You might think, okay, maybe it's time to sell. So unless we wait for that moment, like if we can get out of the housing market right now, my advice is I mean, by the way, this is not financial advice, so please do your due diligence. So what I would do in this kind of a scenario, if I have like 5 investment properties, I would probably sell. I'll sit down and go through all the numbers, and I would probably sell maybe 2 or 3 investment properties just to reduce my debt levels. If you like have, I mean, if you don't have if your debt levels are not that high, say below 50% of your loan to ratio, is like, say for example, your loan your value of your house is say 1 million, and your loan is around you borrowed like only 500,000, right? So you have $500,000 equity on your house. So in that case, you are in a pretty good scenario, because even if the housing market drops say 30% or even 40%, you still can sell your house for 600,000, meaning you still have $100,000 equity on that house. So if you're in that kind of scenario, you probably won't need to sell any. But if you leverage too much, if your debt levels are so high, maybe it's time to sit down and think and reduce your debt levels, because it's really obvious, like interest rates are going to rise. Regardless, interest rates are going to rise. That's inevitable, because we've seen really low interest rates for a decade or so. Now it's slowly starting to go up. So it's better to sit down and make sure that your debt levels are at a manageable. Your debt should be manageable, or even a little bit below. I mean, say for example, as I mentioned before, if you have $1 million property, if your loan is say up to $500,000, so you still have $500,000 equity on that house. So if you're in that kind of situation, you don't need to worry. But if your debt levels are high, maybe it's time to reduce your debt levels. So that's all for today. Thanks for your time. I'll talk to you in the next video. Thank you. Bye.